Okay, so this is an interesting class, a very specific class, right? Life insurance finance. I always put the life insurance finance on there. There are insurance classes at other universities without the word finance. They're wealth management classes, and they're structured for people who are going to sell insurance. I'm guessing most of you don't want to sell life insurance, but I don't know, is that true? How many of your life mission is to sell life insurance to your family members so they avoid you every time they see you? But life insurance industry is an incredible industry, especially if you're interested in the investment side, because they are major investors, especially in corporate bonds. So it is an interesting industry. But the emphasis on the word finance, and I'm broadening that out to finance and actuarial science. How many actuarial science majors do we have? 3 or 4. All right, so we'll definitely have an actuarial bent. Those that took my property casualty class last semester, I can do this class more actuarial than I could do the P&C class because I have more background in life insurance. So we will doing some pricing formulas to get some practice there. So there will be some math. So how do you take this class? If you're an actuarial science major, they've got to make a decision first if they're going to spend their whole life taking exams, because that's the tough part. Actuarial science is an incredible career. Pays you a lot of money to do math all day, which is really fun for a lot of people, but you have to take a lot of exams. But they have to decide pretty early on where they're going to go. P&C, life, benefits. And then a lot of people are hiring actuaries outside of insurance. But life insurance is one of those fields you can be an actuary on. So why would you pick one versus the other? The big key for actuaries is the investment side. P&C actuaries do almost nothing on the investment side. Life actuaries are essentially investment people also doing actuarial science, because the investment side is really integral to life insurance functions. So actuaries, they'll take this class and see if they like the life insurance side, if it's something they want to do. Very different than the property and casualty side. We have UTSA alums that are actuaries at USAA on the property and casualty side. I don't think we have any UTSA alums on the life insurance side. The other issue for actuaries is there's a lot more jobs on the P&C side than on the life side. So you're kind of, from a volume standpoint, you don't have as many options on the life side. I prefer the life side just because of the investment side. One thing that really irritates me, I've got my CPA and my CFA, and I can tell you the CFA is a whole lot harder than the CPA. It's a really tough exam. But then all the life actuaries started taking the CFA exam, and it was a piece of cake for them. And that just irritated the life out of me. But that's how well-trained actuaries on the life side, that's how well-trained they're on the investment side, that they find that exam fairly easy. I don't know any of them that failed it. So, so if you're interested in the investment side, the life actuary gives you that. Now, if you're not an actuary, maybe as a finance major, you want to work in the life insurance industry, and you can certainly do that. It's a pretty specialized industry. It's a pretty large industry. You're used to seeing these $3 trillion companies out there with Apple and Microsoft and Nvidia. The largest life insurance company is probably about 500 billion, maybe, in market cap. We can look that up later, maybe MetLife or Prudential. Not as large as the banks either. Bank of JP Morgan, I think, has $3 trillion in assets. The largest life insurance company is not going to be nearly that large. So it's not necessarily as big as the banking industry, and it's not going to be as big as the tech companies, but it's a pretty sizable industry. It's very specialized, very mathematical. So it does give you some expertise that if you want to work in the industry, you could do that industry your whole life. Just be careful when life insurance companies interview on campus. They're looking for salespeople. They're not looking for finance people. So you want to go through the finance route. So at USAA, it's entering into their financial access program and rotating around, and life insurance might be one place to go. So I started my career in the life insurance company at USAA. So I started on the life side. My first boss, we're still good friends today. She was on the life side. So I have a lot of friends on the life insurance side. Now, if you're neither of that, what do? So life insurance is an important life skill. You're probably all going to be buying some type of product from life insurance industry. So just from a practical standpoint, those that took my P and C class, we talked about, should you buy parts B and C of auto insurance? Did you get this kind of coverage? How much? So there's gonna be some of that. So now the warning. Oh, and I may step on some toes. I'm sorry. Warn me after class if you're in this category, but I'm very, very negative on this industry. So just be aware. There's certain parts of this industry I think are wonderful and they do a great job. And there's certain parts of this industry I terribly dislike. And so you're gonna get my honest opinion on it, and you can disagree with me. If any of y'all work in this industry and you sell some of the products I think no one should ever sell or buy, you're welcome to debate your side of it. I'll be more than happy to do it. But we're going to get into that. You'll see my least favorite product of all, which is the equity-linked annuities and equity-linked life insurance. I hate those products. You'll see why I hate them. I'm going to present it to you. If you sell those, and they're a great product to sell, they have massive commissions, which is why I think they're such horrible products. If you sell those, you can argue your side of the argument. That can certainly be there. I'm going to show you numbers that back it up and somewhat. So just be aware that you're going to get that side of it, but it also offers products that I think are extremely crucial to our society functions. Does some really, really good things, and so we'll see both sides of it. You saw that took my P&C class. Those remember how much I hated title insurance, and it's how negative I was on that. So I'll give you my honest opinion on these products. The big difference between property and casualty, so y'all have auto insurance, right? Probably very few of y'all have life insurance at this point, but y'all have auto insurance. You'll probably get renter's insurance or homeowner's insurance. It's possible you won't buy much from the life insurance side. So it's not as frequently purchased product, but it tends to be much bigger dollar products. So if you want to buy equity linked product, you might come in with $300,000 to buy the product. You're not going to do that with auto insurance or homeowners insurance. So it is a very money center product. It has very complicated products. This is one of the things we're going to talk about, which is one of my negatives on this. They have products that the people selling it don't understand because it's so complicated. I had a good friend here recently. They bought one of those equity linked products I hate so much, and they told me about it, and I just bit my tongue. I didn't say anything because I just thought they made a horrible mistake. Well, guess what? She called me last week, and what did she say? How do I get out of this product? This thing's horrible. And it's like, yeah, I kind of could have told you that if you called me before you bought it. So it's an industry that's a little bit challenged. They have one huge advantage we'll talk about, and that's the tax code. Life insurance is heavily tax favored. And because of that, it gives them some advantages that you should take advantage of. It means that they certainly have that. So just so you know, as we get into this, I'm going to give you the good and the bad, and we can debate the good and the bad on that. So there's no textbook for this class, mainly because the textbooks that exist are really, really focused on life insurance sales. We have 2 exams. Each exam will have 1 or 2 major essay questions, and each will have some major math problem. The math problems will work in class. You also have the YouTube videos that you can go back and practice on them. So the math problems are usually pretty straightforward. The second exam, the math is pretty heavy. It's probably almost 1 essay question on a bunch of math on the second exam, because we're going to be pricing products like you're a life actuary, get into the math. It's not complicated math. Life insurance math is essentially discounted cash flows, which you can do backwards and forwards. You just stick a mortality table on top of that. You got to figure out when people die. That's how you get your in for your discounted cash flow. So it's not that complicated. And then you have 2 papers, and that's what we're going to talk about tonight, because really all I want you to do in this class right now is just start on that first paper. You got plenty of time to do it, really sink into it. So we'll talk about the first paper. You notice anything about the grade on the 2 papers? You notice the weight on the second paper?
One's more important.
Yeah, 30%. Why is that? So I'm going to freak you out on the second paper, but you can handle it. Previous classes, I handle it. So the second paper is a research paper, but I've done all the research. All right. You're going to write a paper on a very controversial topic, which I'm sure you're going to hear a lot about during the election, which is health insurance and healthcare reform. Massive topic. We're going to spend quite a bit of time on that, and we'll get into that, but I'm going to tell you now, you can make your life very simple. You write the paper in class as we go through the materials, because we're going to go through a lot of materials. So I'm actually going to, as we go through that, we're going to have a template that's massive. I'm going to say, I'm talking about this part of the template. You can be taking your notes, doing references to the articles. So by the time we finish the classes, you probably have 70–80% of the paper written. You just got to fill it back in. All right. So that's why it's so important. You come to class, be taking notes, be caught up. If I'm talking on an article and you don't know where I am in the template, you stop me and you get caught up. So it's going to be pretty massive. I really want to cover this topic in detail, because healthcare reform, obviously well, I don't know where it lists on people's top priorities right now. I know inflation's like the top thing, but I think healthcare is still in top 5 or 6 for most people. Republican, Democrat, I think it's still up there pretty high. We'll talk some about Affordable Care Act. We won't get into it in too much detail. We'll talk about the things that it addressed. One advantage of that second paper is it doesn't have to be you're going to write problems and solutions. That's the paper. What's the problem with healthcare and what's your solution? And the huge advantage I'm going to give you is your solution doesn't have to be politically viable. You're going to write it as if you're king for a day and you can do whatever you want to. So that's the advantage. If you had to make it politically viable, it'd be an impossible paper, because there is no political solution to this problem. So we're kind of ignoring that. There really is no way to fix it. So, but we'll talk about the first paper tonight. Attendance is important. If you can't make it to class, then you need to drop the class. You can make up 3 absences by watching YouTube and submitting notes. After that, it can start impacting you, but you can get a bonus if you do come. So if you make every class but 3 and you make up those 3, you can get a 2% bonus. So you can get 2%. If you miss too many classes, I'll just tell you to drop, because at some point you miss so many, it's not worth it to get credit for the class. This is not an online class. I do record all the classes, and assuming there's no technical issues, I put the recordings out there on my YouTube channel. So you will have those. That's extremely important for the math problems, because the math problems have some pretty significant formulas. And those that took me last semester, forget that a few of y'all are in here that were last, but you remember that massive formula for the PNC pricing? Yeah, nothing like that in this class. So don't worry. This class doesn't have that 7-page formula. The formulas are much more straightforward, but there will be some formulas and you won't want to practice on them. On the first exam, the formula is the equitably linked annuity. So we're going to actually do the math on that, so you can see what the insurance company is actually doing, which is the interesting thing about that product, because you could replicate it yourself if you wanted to. You don't need an insurance company to do it and charge you hefty fees, but we'll do that. And then if you do the instructor survey, you get 1% added in. That's my phone number. You can call me. Your best bet, though, is to email me. If you text me, that's really dangerous, because I'll read a text while I'm on my bike and forget that you ever texted me. But emails, I do have a system that not lose those. If you text me or email me and you don't hear back in 24 hours, I've probably lost the email or it never got to me. So then you might call or text me just to make sure that I got it. I don't have an office officially, but I'm in the Financial Studies Center. I think it's 1.0104 in the business building. This is my personal email. You might email both, because I've had troubles with my personal email, people not getting stuff to me, and then my UTSA one, it's supposed to forward to my personal, but it doesn't always. So, so if you want to do both, that'd be fine. And if you do want to call just to talk about the class, or even just talk careers, if you want to just talk careers, I do that all the time. I've had 2-hour+ conversations with students. The morning's the best time. I'm always on a bike in the morning for 4 hours. If you call me, just want to talk careers, I'll talk as long as you want. I'll be panting really heavily, but it's just because I'm going up a hill. But I'm always open to that. And actuaries, you want to call and talk about it. You may have questions I can't answer. I can probably find you an actuary that will answer those questions. I have a few actuaries at UTSA that are really gung-ho to help out UTSA students. So I can give you those contacts. One of them spoke last semester to my class. So, feel free to call me for those kind of things. So let's talk about the papers. So the first paper is on human capital, and then a completely separate topic, immediate annuities. So it's really two topics. So human capital is really, really important for life insurance, and I'll get you started on that tonight so you can start preparing for that first paper. And then immediate annuities, I've got an article. All the articles we're using are somewhat dated, but they're still current, even though they're several years old. If I could find a more recent article, I would use it, but these articles actually do a much better job than the more recent articles. I did find a class on human capital. It's a graduate level class. It was interesting, but we're not going to get that nitty gritty. That class is just, the math is pretty incredible. But he was talking about stuff that seemed kind of ridiculous. Like someone has two kids and they're thinking human capital and which kid do they like better, but they like this kid better, but this kid's likely to make more money. And they're making these, and it's like, yeah, this sounds like something, a way an economist would think. So we're not going to be quite that far into it, but the two articles I have, I think, a little bit more logical on that topic. And then the healthcare reform. This one's been fun because I had some students write this paper and then walk into a healthcare debate, and they just have a blast because they think of 60 things the other person didn't think of because we've gone through them in detail. So we'll talk about this. And the exams, you will know exactly what's in the exam before the exam, so there's no surprises. But those that have had me before know my essay questions can be a little bit complex, and that's true in this class. So you gotta take some pretty complicated things and organize it into a good answer. The good thing about the essay questions that those are submitted online, so they're open book, even though you don't have a book, but they're open notes. And then the math questions are taken in class, closed book. So at least the essays, as complicated they are, you don't have to memorize a bunch of things. So our first exam is not until October. And then the first paper. So one big problem with this class is the grades are somewhat backloaded. So start off strong because, you know, it's, I think midterms are due the Monday after our exams. So that's the only thing I'll have for you, midterms. So it's going to be kind of cutting it close. You might think it's strange the way I do this. I do it somewhat because some students take more than one of my classes, so I'm trying to avoid two things being due at the same time. So I'm trying to spread things out. This is the only class you're taking, just to realize it's kind of back end loaded. One thing I will tell you on the exam and on the paper, given that you know the topics in advance, you can certainly come to my office hours with your essay already written, and I'll tell you if you're way off base. So if you're not a writer, or you're worried you never had me before, come talk to me and let's make sure. I have students that lose big points on the easiest things. If you had just said this one sentence, you would have gotten an extra 3 points, 4 points. So if you come talk to me, I'll be looking for those obvious things that you're leaving out, and I can help you with that. So yeah, some of the people I have before, yeah, I'm picky on the essays because I really want you to understand this stuff in depth. But I'm not going to just leave you out there on your own. Yeah, I can certainly help you. So the essay questions and the paper one, you're more than welcome. What I don't like, though, is you send it by email and say, what do you think? Because I can't grade all of your papers twice. So if you send it by email, I'll look through it really fast and I'll give you really high level comments. But if you want to get into it in detail, come by my office hours and we'll look in it. Set up a Zoom. We can walk through it on Zoom. So I'll do that. So you really have no excuse for not doing well. If you're scared at all, get ahead of the curve. I'll let you know as we go that, yeah, that's an essay question. Start working on that so you can get it out of the way well before the exam. You know, don't procrastinate, get it done, and then come talk to me. And then paper 2 is due that week of Thanksgiving. I'm not trying to destroy your Thanksgiving. I have in the past given more time. This paper is the hardest paper for me to grade of any of my classes by far. Last semester, it took me 30 minutes of paper to grade it. And there's 40 students in this class, so you can do the math. It's going to take me 20 hours plus to grade this paper. So I can't push it back too far because I'll run out of semester. We'll finish the health. We'll finish everything you need the end of October. So you essentially have almost the entire month of November to write it. So there's no reason why you have to wait until Thanksgiving week. You can get it written in advance and get it done. And you're gonna be writing it in class anyway, all right? And then you have the final exam per the schedule, and it's not cumulative. So those that have me before, you can talk to them. I give an exam guide. It tells you exactly what's going to be on the exams. So the hard part of the exam is not trying to guess what I'm going to ask. It's going to be those squirrely essay questions that I like to ask. So any questions on the schedule? I don't know if are y'all using the simple syllabus? Does it make more sense than this? I've got them both out there.
All it does is just makes us acknowledge that we read it.
Okay. I didn't like the schedule's not in the simple one because I didn't want to have to type all of this out, but I'll get caught up. They give us like 1 week, say, hey, you got to do this semester. And it's like, oh, great. So I did it really fast. But you have this one, which is the more detailed one, and the simple syllabus, which has some of this stuff in it.
For the math on the exams, are we allowed a formula sheet or no?
No formula sheet. No, I never use formula sheet. You'll see the math is not too difficult, and it's actually pretty useful math to make sure you know anyway. Other questions? So I'm actually going to start off talking about paper 1 now. And then today I'm going to introduce you to the articles. And then Thursday, I'm going to do economics of life insurance. And so what I want you to do this weekend is read the 3 articles so that next Tuesday we can have more detailed discussion on paper 1. All right. So this weekend, read all the articles. They're not that lengthy of articles. I used to have 4 articles. Now you only have 3. We will cover the other article as part of this discussion, but not make it part of the paper. So you have 3 articles, read those 3 articles. One article is really short. It's like less than 1 page. And then one of them is a little bit lengthier. So I'm going to introduce it tonight and then read it this weekend, and we'll do some prep. So you have essentially almost everything you need for the paper by next week. And then you have like a month and a half to write it. And then here's one of the essay questions. So here's where I go, wow, these are my issues with the insurance industry. So if you work in this industry, just be ready. You might warn me. Why do I have this in my life insurance class, but I don't have that topic in the property and casualty class? So I don't think the property and casualty industry, even though it gets beat up in the press much more than the life insurance side, I don't think it has the same ethical challenges as the life insurance. And you're going to see the number 1 reason is the commission. When you sell something by commission, I think it distorts your incentives. And we'll talk a lot about incentives in this class, incentives on the life insurance side, incentives of the healthcare industry. Incentives is a big part of this. What happens when you pay people to do things? What do? They do those things. And you entice. So, I mean, we'll talk about it. When you tell a life insurance agent, you sell product A, we'll give you $500 commission. You sell product B, we'll give you a $50 per commission. Now make sure you sell the product that's best for the customer. What are they going to do? What would you do? You got to feed your family, don't you? $500 or $50, it takes me the same amount of time. Yeah, I think I can rationalize that the $500 product's the better product. So you can see we're going to be going with this ethical challenge. And I'll give you some specific examples because I have several of them at my church. They know they can call me. It's usually sweet little old ladies because they outlive their husbands. And almost 100% of the time, it's, I got a problem with my life insurance. I think they're ripping me off. And I go, yeah, they are ripping you off. I'll tell you some of those stories, especially the Daniel stories. That's my favorite story. It's the saddest one, but we ended up winning against the life insurance company. So it's an industry that has some huge challenges. Now, some of you might think the P&C side has challenges right now because they're charging so much, right? Your auto insurance, didn't it zoom up here pretty high this last year? Homeowners, it's like they don't want to sell homeowners to anyone anymore. They just don't like the unit. So, but those are not ethical issues. Those are claims issues. Their claims are going up, and so they're raising their prices. So it's just kind of an issue that's the only way they know to handle it. But on the life insurance side, it really is an ethical issue. And then you'll notice what we're going to do for really a big chunk of the class. You're just going to go product by product by product. Life insurance, what's term, what's permanent, what's universal life, what's variable life, what's equity life. We're going to do that. Then we'll get into annuities, immediate, deferred, the different type of deferred annuities. And then you notice we're going to spend quite a bit of time on health insurance because it is a huge, huge, huge issue, obviously, in the news today. I'm not going to try to change your opinion. I will critique presidents. President Obama is a lot smarter than I am. He knows this a lot better than I am because he had a bunch of advisors working for him. But he's not here, so I win every debate with President Obama. So that's kind of my advantage. You can certainly take the other side of the debate if you want to. And I'm also going to talk about the political issues here, because I can tell you President Obama wanted to do things he couldn't do because of the politics. So he had a demand side solution. I'm going to argue healthcare needs a supply side solution. Why didn't he do a supply side solution? That's what Hillary and Bill did. And what I do, they got beat up on TV by commercials from the industry. So you can see why I'm not telling you to do something that's politically viable, because it's practically impossible. Whatever you do, you would be beat up by the other side. So I think Trump and Harris are gonna find that out, right? Do you think they're gonna want to debate healthcare? It's a very complicated topic. Whatever you say, the other side is going to exaggerate it. They're going to talk about, death panels and all these kind of things. So we're going to talk about it, just trying to keep to the facts and somewhat ignore the political side of it. And then we get into the mathematics, pricing of insurance, and benefit of survivorship. I'll show you my favorite product. I tried to get it patented at UTSA. My boss loved it, but I could never convince the life actuaries. They thought it was a stupid product. I'll try to convince you that it's a pretty good product. And one of you actuaries, one of these days, you'll start your own company. You'll call me. I'll be an advisor, and we'll start this product, and we'll take over the world because I think it's a good product. So that's the benefit of survivorship. Pretty amazing thing. And then one of my favorite topics that you don't see on the property casualty side, but you see on the life insurance side, is asset liability management. Life insurance companies, they buy assets to match their liabilities. And it's an extremely, just as matched as you can see in any industry, better than banks, better than any other industry. The life insurance side, they buy very precise bonds. What credit quality, what duration, what convexity, what key rate duration. I mean, they get it down to almost the day. I need a cash flow January 5th, 2028. I need it on Tuesday because someone's going to die on Wednesday. They're incredibly precise cash flows. So we'll talk about that. And some of you actuary science majors, this could be your career. It's an incredible career. You would know investments as well as any investment professional out there if you did this job. I'll talk about my friend John that was in that department that I got to know pretty well, just learning the industry. Just incredibly smart person, just incredibly mathematical job. Yeah, the downside, this is a great job, it'd be a great career. The downside is there's not many of these people. Life insurance companies like Met might have 2 or 3 people doing this. They don't have an army of actuaries. So their opportunities aren't there, but it can be a great career. We'll probably be behind at this point. So that may be where we end, because I usually go over on health insurance. So if that's the case, we might have to shortchange accounting and regulations. Does that hurt anyone's feelings? Are you like, oh, I really want to do a bunch of accounting? I will high level accounting, life insurance. It is a little bit unique and unusual, but we probably will be behind. And in regulation, you can read the class notes and pretty much get everything you need there. All right. So let's look at Canvas. So these are the class notes. I will walk through the class notes. There's no textbook, but the class notes, I'll follow them very closely. I've had students complain that the class notes is kind of dense text, and sometimes it's hard to read in class. I don't want to create a separate PowerPoint because now you got 2 sets of notes. I prefer to stick with the class notes, and if you can't see it, slow me down and I'll highlight as I go. I just prefer to have 1 set of notes. And if you do it on your computer, I mean, you're better off taking handwritten notes, as y'all know, I believe strongly. But if you're doing your computer, there's probably a way you could take notes as you're going kind of off to the side or somewhere. But if you do take notes in the Word, then your page numbers are going to be different than mine. So just keep me posted if you're getting behind. We'll get through some of these articles in here. As we go, and you'll see, I'll give you a really great thing here at the end that you could use in an interview. Why do deferred annuities look like a short straddle on interest rates? It's a pretty cool topic. So I'll give you some really cool stuff that you can bring up in the interview. All right, let's talk about the papers. So first of all, I gave an example paper for formatting. You don't have to use this formatting. I just encourage you for all your papers from now on, because you need to put papers on LinkedIn. That's something that's a lot of students don't have a portfolio. We were talking to some students from UTSA, and is like, we never write papers. Everything's multiple choice. So they don't have anything to put on LinkedIn. And so you need some papers. The papers in this class, the health reform one would probably work as a pretty good paper to put on LinkedIn. The first paper may or may not work. But if you're going to put it on LinkedIn, you want to make it look professional. And so I give you an example that you could. This is from my investment class. I showed this something similar to this today. This might be the same one. Yeah, it looks like it's almost the same one. But this is the format we started using about 10 years ago. And the student who came up with this, the first time I saw it, I said, that looks really professional. What did you do? And so he went down and took some of my financial analyst journals from the library, and he just looked at how a paper in a journal is written, and he just copied that format. And that's the format he came up with, and we've been using it ever since. You have an abstract. You don't always need an abstract for a paper like this, but the abstract can either be a summary of what you said or just telling the audience what you're going to do. In this paper, I'm going to do an analysis of healthcare in the United States, talk about the problems, and present solutions. That could be your abstract. Good use of titles, good use of bolding. One thing that's extremely important is your paragraph length. Keep your paragraphs short. Don't go over 10, 15 lines. It just gets too cumbersome. I had one student, I can't remember how many pages the paper was. It was several pages long, and it was one paragraph, the entire paper. That is the worst thing in the world to have to read. In fact, if you do that, like on the exam, I'll probably put paragraphs into your paper just so I can read it. I mean, think of me as a professor. I'm looking at the rubric and I'm looking at your paper, and I got this massive paragraph. I got to now go back and find my spot again. It's a mess. But you wouldn't want to put that on LinkedIn anyway. Would this paper be okay for you on LinkedIn? You'd be okay with this? Looks pretty professional, doesn't it? So 2 columns. You don't necessarily have to put the line in the middle, but I think it looks pretty good. Narrow margins. You're going to use graphics, and there are some on the healthcare paper where graphics would make some sense. There are a couple graphics in the first paper that would make some sense. So just make it look professional. So again, you don't have to use this format. Obviously, this paper won't help you at all, but if you want the form, some are asking for the format. Some weren't sure how you did this W thing, and I can't remember either exactly how I got that to work, but so if you can't figure that out, you could use this format and just replace the W with whatever. I think it looks pretty cool, but you don't necessarily have to do that. But the key is get stuff out there. So how many things do you have on LinkedIn right now? So the people taking my security analysis class, they almost always put that paper on LinkedIn because that paper works really well. I don't know. Well, I want to ask, have you done it?
Yeah, I did. I was looking at the format. I did change it from when I did the submission because some of them I just put it plainly. But yeah, when I put it on LinkedIn, I fixed the format.
Yeah, you want it. I'd say almost anybody. Well, one of the papers in that class was like 150 pages long. No one's going to read 150 pages. So they're going to be reading the beginning, the exec summary, and then the rest is flipping too. So it really is, part of it is a beauty contest of just making it look as pretty as possible. But you do want it to start off pretty well because they probably will read some of that. My investment class, all of the papers in that class should go on LinkedIn. They're perfect. And in security analysis, they do. This class, it kind of depends. If you're an actuary and you're interviewing with the life insurance side, then yeah, these 2 papers work pretty well. They're good topics, good meaty topics to put in there. But you should have papers, you should have models that you built that you go out, put out there. Those kind of things need to be out there, and your competition is not too good. Most college professors hate grading papers. I've just decided it's part of my job. I just got to do it. You got to be writing papers. That's what you do in finance. So yeah, it takes me a lot of time to grade, but it gives you something that you can put out there on LinkedIn. And I am not using AI to grade your paper. Maybe 5 years from now, I'll figure that out, but I haven't figured that out yet. So I'm reading your paper. So, you know, I'll give you some feedback. I've had some students where English is a second language, and so writing scares them a little bit. So if you need help just with writing, get your paper done early and come talk to me, and I'll help you with what I had one student, incredibly excellent student, really good writer, but she struggled with the English. And so we went through, before she put it on LinkedIn, we went through it in detail and fixed a lot of the grammar issues. And she ended up with a really, really strong paper. So, you know, if writing is an issue, strengthen your writing. We write a lot in finance. It's just the nature of how we communicate. Not because people are going to read what we write. We write so we can prove we did the analysis. So it's our documentation. So it needs to be there and it needs to look professional. So, but you don't have to use this. But you do need to have good paragraph length, because that makes it hard to grade. I hate double space. If you send me a double space, I'll probably make it single space, because it's just, I hate reading double space, and nothing looks more unprofessional than a double space one column paper. It looks like a college paper. You don't want to put college papers on LinkedIn. Oh, another college student. You want to put a professional paper on LinkedIn. So it looks good. All right. So that's out there. If you want to use that format, again, you don't have to use that format. And then into the papers. So your papers, your files for paper 1 are right here. You got a rubric. Follow the rubric. If you're not sure what goes in that part of the rubric, come talk to me. I don't understand it, how a student will leave one entire part of the rubric out of the paper. That just doesn't make sense to me. So have everything on the rubric. So you have 3 papers. And then for paper 2, yeah, it's pretty lengthy, including a video I'm going to have you watch. It's a pretty old video. I wish they would update it, because nothing in the video is really that out of date. The issues they're discussing, and it's an excellent video. So I'll actually give you time off of class so you can go watch the video, because it's pretty eye-opening. I actually found a longer version of video where they cover a few extra things. But then we have this document right here. Let me scare you to death here. This article is, I don't know how long it is, but it's over 100 pages. This is just a bunch of articles on this topic. But it is highlighted. So we may not be able to go through all of these, but we'll hit a lot of these. And what I'm trying to do is expose you to those biggest issues that are hitting this, and there's a lot of them. That's part of the problem with healthcare reform. It's not a 2-3 problem issue. It's a massive issue. A lot of people say, oh, it's those pharmaceutical companies. Well, you may be surprised, hospitals are a bigger part of the problem than pharmaceuticals. And I've got data that will show you that hospitals are a big part of the problem. We got baby boomers retiring, and they're Medicare. Medicare is essentially bankrupt, and they're gonna have a lot of medical costs. And most of them are taking 5 or 6 pills anyway, you know, all these kind of things going on. And now we have this new pill for weight loss. It costs what, $14,000 a year, but it seems to be effective. What's that going to do to healthcare costs? You know, there's a lot of issues. We have uninsured people in the US, and everybody else says, well, the UK is so much better. Why don't we just emulate the UK? So I'll show you some articles that the UK, they're having the same problems we are. They're just not spending as much money as we are, but they got the same serious problems that we have. Plus, they have long wait times, which we don't have in the US. So, you know, we're going to see there's no obvious, easy solutions out here. And then I'll show you some solutions. And then in the solutions, I'll say the problem with this solution is women are going to end up having to spend a lot more than men. We go to this solution, so we'll have to talk about that. How do you handle that? So there's a lot of intricate problems. The tax code is a huge part of this. We'll talk about the tax code and how it makes this problem a lot worse. So yeah, 191 pages. Obviously, we can't get through all of those, but fortunately it's highlighted. So some of these articles, I may only hit like 1 or 2 paragraphs, because I want to just show you, here's an article here. Why don't we have enough doctors in the United States? What's going on with especially primary care doctors? why doesn't anybody want to be a primary care doctor anymore? And we're running out of them. So, all right, so be aware, that's a scary document. But let's talk about your paper one. But any questions up to this point? Right with you. Has anyone already gotten online and dropped the course? You don't like writing? But all right, let's talk about paper one. So let's look at the rubric for paper one, so you can kind of see my rubric, because it's not exactly a rubric. My rubrics just tell you what should be in the paper. I don't talk about style or opinion, or just here's the topics. So when you read these articles, what I highly recommend is, if it has an abstract, start with the abstract and just notate, what are they trying to prove in this article? What are they trying to teach me? And then don't read the article, jump to the very end and see if there's a conclusion. So abstract first and then the conclusion. So figure out what they're trying to argue, and then what do they think they proved. And then once you got that down, then go back and look at their proof. So they can go through, we proved this by doing this. And this first paper is just exactly like that. They have a function that they're going to optimize. And that's the purpose of this article, is their objective function. And what they're going to say, here's our objective function. This is what we're trying to maximize. We'll talk about the function. Looks a little silly when you look at it, but it's actually a legitimate function. And then they're going to say, here's how you maximize it. And you can go through that. And these are the topics that they talk about and maximizing it. So you can go through these and see their arguments. Some of their arguments, I think, are very counterintuitive, and I actually question if they're correct or not. And some of them are very intuitive. I mean, like the obvious thing, someone with more dependents needs more life insurance. Does that seem logical? It seems kind of logical, doesn't it? Some of them pretty obvious. What about wealthy people? Do wealthy people need more life insurance or less life insurance? We're going to talk about that. What about someone who's risk adverse? Doesn't like risk. Do they have more life insurance or less life insurance? And what is the key to all of this? I can say the key to all of this is human capital. Human capital is the link to the question they're answering. So start off with the abstract. So if we look at this article, I can't remember this first article, it has an abstract, but it does have a conclusion. So here's the first article. This is probably the most difficult article of the three. And it is an old article, but again, I cannot find a better version, a more current version. So it has a intro. I don't know if y'all recognize one of these names. Y'all know this guy here? I guess I shouldn't ask us for our investment class, because they didn't know who Markowitz was. Anybody heard of Roger Ibbotson? You may have heard of the market risk premium. Does that sound familiar? So Dr. Ibbotson is the market risk premium guru. That was his entire career. There's a book he published. He's retired now, and he sold his company to, I think, to Morgan Stanley or somebody. But there's a book that he published. You get the book, and he gives you the market risk premium. He's just the guru. In fact, it's kind of funny. He has one article he wrote where he was summarizing all the history of the market risk premium, and his footnotes kind of say, as Ibbotson and so said, blah, blah, blah. However, Ibbotson said he's quoting himself by 80% of the time. He's debating himself with his previous articles. So he's just like Mr. Guru. So why is he writing an article about human capital? I can't answer that question. This seems like a topic that has nothing to do with his field of research. I've met him one time, made an idiot of myself. I was talking about cat bonds, and he didn't know what a cat bond was. And they're catastrophe bonds. Y'all know catastrophe bonds, right? We talked about it last semester, but it's like, what is a cat bond? So my one time to meet him, and I made a fool of myself. Chin took over for him when he retired, and then they sold. And Ping Chen was actually here in San Antonio not too long ago. I don't know the other two people. So probably more than likely, these two were the ones who actually wrote the paper, and then they borrowed Ibbotson's name to stick on it so they could get the article out there, more than likely. So I don't think Ibbotson has much background in this area. But let's look at this abstract. He says financial planners and advisors increasingly recognize that human capital must be taken into account in building portfolios. I don't believe that. I've never met a financial advisor who even used the term human capital. So I don't believe the first thing out of the box, but I like this article. So I just disagree with that one comment. You can try it if y'all meet with a financial advisor, ask them, what do you think about human capital? I doubt they're going to say what it says in here, but human capital is not an asset class. So what is human capital? Anybody want to guess before we see their definition? It's your largest asset. It's my smallest asset.
Life expectancy.
Well, life expectancy has a lot to do with it. We'll talk about that. But if you had to say it in present value terms, what would it be? All right, and how would you calculate that? So yeah, it has to do with the worth of human life, kind of in financial terms.
How much more life do you have to live?
Well, your life expectancy will work, but what if you never get a job? What would your life worth be? What if you're going to live off your grandparents the rest of your life? What would they say the value of your life is? And you never claimed, you never did anything. They're probably hoping you would move out, right? So what's a big part of human capital? Your earnings, lifetime earnings, but then what are we going to do? Present values. So present value is really key. Don't forget that, because what happens to present values? You have what? A discount rate. So if you have a discount rate, that's going to be really important. All right. So human capital is the present value of your future earnings at some discount rate. All right. So he's saying is not just another pre-endowed asset class. It contains things other assets don't have. Probably the most important, and y'all been mentioning, that's what y'all are talking about, right? Mortality risk. What is that? That's your risk of dying. What happens to your human capital if you die suddenly? It goes from what to what? It goes from a big number to zero. Unless you can figure out some way to still make money. Maybe they'll take your DNA and plug it into an AI machine and somewhere, maybe you'll still be making money, but more than likely not, at least not for a few years. Elon Musk may figure that one out. But yeah, so human capital goes to zero the second you die. So there's a high correlation to your life expectancy, but not only life expectancy, also your actual life. Life insurance hedges this mortality risk. In fact, it's a practically perfect hedge. Because what do most people do when they buy life insurance? They usually buy life insurance equal to their human capital or some approximation of that. So my human capital was 2.2 million. So I bought $2 million in life insurance, and then I'd suddenly die. My family gets $2.2 million. How good was that hedge? You lost 100% of your human capital from mortality. You got 100% back life insurance. That sounds like a perfect -1 correlation. Perfect hedge. All right, so here's the key right here. This sentence right here. This is what they're after. Human capital affects two decisions, all right? Make sure you have that. When you're reading this article, be real clear. Human capital affects two decisions. I was reading a book on retention, and the woman who wrote this book, she said there's a lot of students that read the textbook for class and there's zero retention. They get nothing out of it because they're kind of just meandering around. If you read purposefully, what is the author trying to convince me of? So you're looking for that, you're seeking it out, you're going to have a lot better retention. So be real clear for this article. It's right there. Human capital is linking two decisions. So you have human capital. It's going to be important to two decisions. What are they? How you allocate your assets. What would that mean? Between stocks and bonds is the main thing they're going to talk about. But how you allocate between stocks and bonds. Do you buy risky assets or you buy low risk assets? All right, that's the first discussion. The second one, he doesn't word very well, but the demand for life insurance. Essentially what he's saying is how much life insurance. So he's saying your human capital is going to influence whether you buy stocks or bonds. You probably have never thought about that before. We're going to talk about it in this article. And I bet you anything your financial advisor didn't sit down with your human capital and say, oh, you're in that career? Oh, then you shouldn't have so much in stocks. I bet they haven't done. You let me know if you have talked to a financial advisor. Ask about your career before they decide your stock and bond allocation in the terms that they're talking about. And they're saying your human capital is also going to affect how much life insurance you buy. That one's a little more straightforward, but we're going to get into that. So that's the key to this whole paper. And so again, another sentence I don't agree with. Historically, asset allocation life insurance decisions have been analyzed separately. That's true, but he somewhat implies that financial advisors are using human capital for both of those decisions, just separating them. I don't think financial advisors use human capital for the investment decision. I think they only make it the life insurance side. But he's saying they need to stop doing that separately and need to combine it. So, and then if you go to the conclusion, well, here's the formula right here. This is the key. You definitely, so here's one of those easy points. Stick this formula into your paper. You can just take a snip of it and put it in your paper and you get full credit for that part of the rubric. How easy is that? And about 20% of students don't do that. Why do I want to put that in there? Because this is key to the entire paper. All right, y'all know how to read this. So what does this mean? What are they trying to do? Maximize something. What's E stand for in economics? Expected value, very good, of something, of a U. You alive and you dead. What does U stand for as economists? You don't use the word, you don't use this word, you use a word that starts with H, but they use, economists use a word that starts with U. What did you use in your economics class? Sounds like the company that sends your electricity to you. Utility. What does utility mean? Your satisfaction, your happiness. So they're trying to maximize the expected utility, happiness of your alive state and your dead state. All right. And how are they going to do that? Well, the D is a strange one. That one we're going to have to, it's kind of hard to read it. The D is essentially your bequest motive. How much do you want to leave? So if you think about it, if you want to leave a lot of people, a lot of money to your heirs, that's kind of a big impact on your live state. It's going to have, so that's what they're talking about here. And the Q, anybody know what QX is? We're going to be, if I tell you later in the class, we're going to be using a lot of QXs. Does that help you at all? You know what X usually means, don't you? Something related to time usually. What do you think it might mean with human capital? Not time necessarily, but something more specific. Maybe your age. Yeah, your age. Q of X is your age. So anybody know what Q of X means? This is 1 minus Q of X in the alive state, and it's Q of X in the dead state. Any guesses what Q of X means? We're going to use it in our pricing formulas.
It's the probability of death at that age.
Probability of death, exactly. It's mortality. Your mortality at age X. So what choices do you have? You can live or you can die. There are no other choices. Okay. I had an actuary once in life insurance, and it's like he was talking like he was about to bring up a third what he was talking. I was like, why do you use such complicated language? You're either dead or alive. It's all right. So in your life stage, that's 1 minus QX, which is probably for you guys is like 99.9%, right? Very, very low probability of death. All right. What about the W? We know what the H is already, don't we? We've been talking about it. That's your human capital. What's the W? Your wealth. So your current net worth is your wealth plus your human capital. Could you sell your human capital? There are people selling their human capital. Have you seen that? Some of these NFL football players. I'll send you all my future NFL earnings and my advertising, and you give me the money today. They won't do 100%. Why won't they do 100%? Things say, well, I'll just retire from the NFL then. You won't do anything. But they may do, they want, you have incentive to keep trying as hard as you can. But there's one article, we might look at one article, a guy's, and I don't know if it's NFL, NBA, I think it was NFL. He sold it and then he had a serious injury right afterwards. There's college students doing this. I don't know if y'all have seen this. College students are paying for their college by selling some of their human capital. Have y'all seen these articles? Have y'all tried that? Sell your future earnings If you die, they're just out of a luck. So human capital is becoming more of an asset. People are actually creating an asset out of human capital that you can actually monetize today. So you have your wealth and you have a human capital. For a college student, this might be zero and this might be $2 million. For someone like I who's retired, this is almost everything. And then human capital, you know, a little bit UTSA pays me, that's my human capital. So most of mine is wealth. So these shift over time. And then when you fully retire, you're not doing anything, you know, your human capital is essentially zero. And then you come over here, the D is real important here. And this is what we're talking about, what you want to leave to those versus what you want to give to those who die. So this is kind of how you want to handle the people that are still around, whether you're living or dying. And then the QX and your wealth. And then anybody want to guess what this is? The only piece we don't have left. We talked about wealth, which is your investments. We talked about human capital. What was that third piece? It's right there at the top. Your life insurance. So where did human capital go? You're dead. It's zero. There is none. All right. Why isn't there any life insurance up here? You're still alive. You don't get any. Right? So that's the formula they're after. They're trying to maximize that formula. And what they're trying to figure out is, how does human capital impact this formula so that it changes how you allocate your investments and how much life insurance you buy, all right? Y'all see what they're having. It's kind of a complicated thing they're bringing up. And then the next thing to do is go to the conclusion. The hardest part of this article are the case studies. Some of them are really, really simple, and some of them are quite complex. The case studies are not in the rubric. So the rubric pulls out the pieces. I'm going to show you the pieces that they're covering, and it's pretty straightforward, but the case studies hit those pieces kind of not quite one-on-one. There's a little bit of jumping around that they do. But then at the very end, you get their conclusions. And so they talk about how human capital changes over your lifetime, which is pretty obvious. It shrinks over your lifetime as your wealth increases, hopefully. So they divided a unified model to help individuals, investors with life insurance and asset allocation decisions. All right, again, that's what they're after. And then here's their final conclusion. You might find this list of conclusions easier to read than the case studies. So you might start with this so that you have a good idea where they're going with the case studies. A couple of case studies I think you're going to find. So who should invest more? So you have someone who their livelihood is they're a stockbroker. They're heavily in, their whole life is about stocks. That's what they do. Should they have a higher allocation to equities or a lower allocation to equities? What do you think an advisor would say? So someone comes in, their whole life's about the stock market. And you're going to tell them what percentage to put in stocks. What would you think? A higher allocation or lower allocation? And why would you say lower? That's what they're going to argue, lower. Yeah, because what happens if the stock market crashes? Your human capital is going to crash. And if they have their portfolio, their wealth also in stocks, that's going to crash. All right. But what do you think most stockbrokers are going to do? They're going to put it all in the stocks because that's what they know. It's one thing they're ignoring here with the human capital is your knowledge. The people they're going to put heavy in the stocks, like a Supreme Court justice, because they have this real steady income that's set for life. They may not know much about stocks, so they ignore that knowledge and comfort part. So yeah, so you'll see some things they're going to say, and we'll talk about optionality too, which is extremely important as well, and we'll get that in the second article. So you may start here. So let's look at the pieces. If we go back to the rubric, let's look at the pieces that you're going to cover. So he's going to talk about the magnitude of human capital. This is where students lose a lot of points on the paper. So make sure you're real clear on magnitude. What is magnitude? Magnitude means the present value of human capital. So what is in the present value of human capital? It's going to be your training, your skills, what field you go into, but it's also going to be that discount rate. So make sure on magnitude, you talk about the discount rate. So who has a higher discount rate, the Supreme Court judge or the stockbroker? Whose human capital is riskier? Stockbroker, they're gonna have a higher discount rate. So the stockbroker's human capital is gonna be smaller. Just based on that, who needs more life insurance? Well, if you have higher human capital, you need more life insurance. And the Supreme Court just has a lower discount rate, so their human capital is larger. Who needs more life insurance? The Supreme Court just. The stockbroker needs less life insurance. Why? Because his human capital is so risky, it's less valuable today. That's the part a lot of students struggle with. I don't see that. Right. So magnitude is really important. Remember magnitude, it's not just your skills, it's not just your career, it's that discount rate. What drives that discount rate? There's two things that drive the discount rate: the volatility of human capital and the correlation of human capital. So a more volatile human capital. So I haven't been to Men's Warehouse in a long time. But I think it's a heavy commission-based job, don't you think? You can tell, right? If they give you a pair of pants when you walk out, they have 4 shirts and 4 ties, and I mean, they're ready to sell. I just get the sense they're heavy commission-based. What happens to that career when we go into recession? Who's buying clothes at Men's Warehouse in recession? So if you have a job, it's very volatile, right? Commission-based, and it's a job that their income drops dramatically in a recession. It's highly correlated to the economy, to stocks. You're gonna have a very high discount rate for something like that. Commission-based, very volatile, highly correlated to the economic cycle. That's gonna give you a very high discount rate. It's gonna bring your human capital down. It's gonna mean you need less life insurance. It's probably the hardest part of the whole thing. So these 3 things go together. The magnitude of human capital is what drives your earnings and what drives that discount rate. And what drives the discount rate? It's the volatility of human capital and the correlation of human capital. All right. These 3 right here is probably the most missed points on the paper, and it's 12% of the paper right there. Well, more than that because of the way I do the critical thinking. Mortality is the easiest one. So you can look at that. Mortality, life insurance is a perfect match, perfect correlation. That was pretty easy to talk about. Risk tolerance is pretty straightforward for most people. People who have low risk tolerance do what with stocks? They buy more or less, buy less. That's pretty straightforward. People with low risk tolerance, what do you think they do with life insurance? They're going to buy more. It's kind of intuitive. If you really don't like risk, then you're probably going to buy more life insurance because you're worried about that risk of dying. Wealth. If you have a lot of wealth, how much life insurance do you buy? How much life insurance does Bill Gates need? Probably not any. Right? If he dies, or his heirs going, oh my word, my dad died. How am I going to make it? No, it's like, I'm sorry, you're only going to get $10 billion here. That's all we can give you. So yeah, wealthy people don't need life insurance. Why? Because they've essentially insured themselves. They got plenty of wealth. They can leave it. If they die, it goes to the heirs. So wealth reduces the need for life insurance. What does wealth do to investing? Should Bill Gates have all his money in the stock market? Probably not. I was dealing with a man here locally. He's from India. He started on the business. He's now worth tens of millions of dollars. JP Morgan was going to stick him heavy in the stocks. It's like, yeah, I don't need that headache. Don't put, why risk your wealth in the stock market if you got more than you need? So wealth, generally people get more conservative the more wealth they have, but you'll see it in the paper. They'll talk about it. Bequest is life insurance is pretty straightforward. If you need to leave money to your heirs, you have people depending on you, you're going to need more life insurance. That's pretty straightforward. Now they make a comment in the paper that a lot of students don't agree with. They say that bequest motive, those dependents that you're worried about, they say has no impact on your asset allocation. That guy I just mentioned from India, his bequest motive had a huge impact on his asset allocation. And the way it hit him was, I want to leave a lot of money for my sons. I want to have enough for me, but the money I'm planning on leaving for them, then I can spend on myself. I can be real risky with that because it's their money. So I can stick that in the stock market. So that was kind of his logic. So that bequest motive actually did very much impact him. So I'm not sure I agree with him that. You can read that and see if you agree. But their argument is the bequest motive only impacts the life insurance decision. And then so easy points right here. They make the comment, more research is needed. Just make that comment and look at where the more research is needed. They ignore tax law from some years. This is all pre-tax. That certainly has an impact. Also, the only life insurance they consider here is annual term. And if they looked at some of the other whole life, universal life type of policies, they would probably get a different answer. So that's all the other, they tell you where more research is needed. So these are easy points. Just find that column. It's one paragraph. Just put it in your own words. Easy points there. And then you have a second article which brings in the concept of optionality, which I really love. I think it's really interesting concept. So that article, well, I don't know if so here's the first article. The second article is only one page. I think I cut it to just that one page. I used to put the whole thing in there and it's just confused students. So yeah, I just cut it off where it's stock. And some of this actually has nothing to do with what we're talking about. And it's really old, so it doesn't matter. So I'm really after this concept of optionality. And so what they're saying here is, so we're going to talk about options in this class because you're going to see there's optionality into annuities. So an option is the right to do something, but you don't have to do it. And their argument is obviously investment portfolios have the optionality. You could buy an option on your portfolio. You could hire a manager that aggressively manages your portfolio, trying to take advantage of stuff. There's things you can do optionality wise on your investments. He's saying the human capital has options. You can change career. You do something different. So let this sink in. Essentially what they're saying is early in your life, your human capital has more options. Later in your life, your human capital has less options. So what they're going to argue is early in life, you have so much optionality in human capital, there's no reason to put optionality into your investment portfolio. But then as you get older and you lose the optionality of human capital, you need to put more optionality into your investment portfolio. I agree with that, except for their conclusion. So I'm going to tell you, when we talk about it next Tuesday, I'll tell you, I like the concept, but I hate their application. I'm going to give you a different application. Their definition of optionality investment side is active management, which some of y'all know I don't even like. My definition of optionality is options. I think older people should actually buy options on their portfolio. I actually think back in 2020, when interest rates were essentially zero, I think elderly people would have been better off 100% in stocks hedged. They would have been putting 40% in stocks and 60% in bonds that are making them nothing. So we'll talk about that. So I love the concept. The second thing they're going to talk about is why do young people buy stocks? And this is something financial advisors get wrong all the time. Financial advisors talk about time diversification, that you spread those risks over many years. That is not why young people buy stocks. Actually, stocks get more risky the longer your horizon, not the shorter your horizon. I can show you that mathematically. If you get Bodie Kang's investment book, he has a whole appendix that shows stocks are riskier the longer your horizon. So why do young people, anybody know why using the concept of human capital, why do young people buy a lot of stocks? But they can afford risk more, but specifically, you're kind of at the cusp of it. So think about human capital. Yeah, but try to avoid the time argument. All right. So
More money faster,
what?
more money faster.
More money faster. Not sure. I'd have to think about that. All right. So we're kind of running out of time. So think of human capital as an investment. If human capital is an investment, does it look more like a stock or more like a bond? For most people. So the stock market falls 50% one year, it's up 20%. How many of your incomes in the next few years is going to be up 30%, down 30%, up 40, down 20? You're probably going to have an income that's going to go like that. Unless you lose your job, you may be out for a few months, but doesn't that look more like a bond? For most people, human capital is more like a bond than a stock, which means your biggest asset right now is what? It's a bond. If you have 99% of your wealth is in human capital, which is a bond, what can you do with the other 1%? You stick it in the stock market. All right. So I think that's what you mean by they have more to invest to risk, right? Because they have so much safe right now. Most of you, I mean, with your college degree, you're pretty well set. You actuaries, you are set for life. I mean, that is a very stable income. It's a very good career. If you can handle the exams, you got it made. Very, it looks very much, it's like a bond that increases with inflation. It's like the perfect safe asset that you have. So yeah, and I laugh when I see Vanguard and Fidelity telling 22-year-olds to put 90% of their money in stocks and 10% in bonds. No, put 100% in stocks. There's that 10% is a waste of time and money. Just put it all in stocks. At your age, just stick it in the stock market. And that's kind of what they're talking about. Your human capital was a bond. You already got plenty of fixed income. Load up on stocks. All right. So make sure you're clear on that in the article. All right. Thursday, I will probably talk a little bit about the last article. It's the easiest one of all. And then we'll talk about the economics. So this weekend, what are you going to do? Read the 3 articles. All right. We'll do a seating chart on Thursday, mainly so I can get to learn your names. What we did last time, just to make sure when you get into the article, one study that's been done with college students is they hit readings, some pretty complicated readings without any prep work. And a lot of it just doesn't sink in at all. And these are complex. The first articles are fairly relatively complex. It's not as bad as it could be. So if you go into the article already knowing what they're going to say before you get into the details will stick with you a lot better. Does anybody remember what was this? What were these 4 authors trying to prove? So how many decisions are they trying to help you with? Yeah, I remember that. Was it 2, 3, 4, 5? Not 4. When I say what the answer is, you can tell me what you're thinking, because you might be breaking into more categories, but I'm only thinking 2. They can tell you, can you remember one of the 2 questions? So asset allocation, and what's the second one? Yeah, so they say demand, I like to say the amount of life insurance. And what was the linkage of those 2? How do you make those 2 decisions? You link it with one thing.
Human capital.
Human capital. So be real clear. Don't read an article if you don't know what they're trying to achieve. They're trying to achieve this. Say we can do a better job on asset allocation and life insurance. We're going to link those 2 decisions using this thing called human capital. Human capital is an asset, so it impacts your asset allocation. Human capital has a -1 correlation to life insurance, so you can protect human capital with life insurance. How do you make those decisions? The second question is the easiest thing of all. You just give me the objective function. I want you to look at it and get comfortable with what that objective function is. They're trying to optimize your alive and your dead state. And human capital impacts those 2 states. Defining human capital should be pretty straightforward. There are some graphs in the article you might want to bring into your summary that make a lot of sense. And then probably the weakest part of the paper for everybody are these 3 pieces, which is a big chunk. It says 3%, but if you look at this, I've got coverage at 40%. I have clarity at 40 and clerical thinking at 20, but generally the coverage impacts the clarity and critical thinking pretty well. So if you cover everything, but the writing just terrible, the clarity and organization hurts. Or if you cover everything, but it's just bare bones, you don't add any extra discussion, then the critical thinking. But kind of think of this, that these are, instead of 3%, it's really more like 8%. So this is a big chunk right here. So magnitude, I don't know if y'all remember on that one, but there's, anytime you're looking at the magnitude of something, we're talking about in present value terms. So human capital is the present value of your future income. You got 2 big things. You got your income, you got the discount rate. So make sure when you're reading this paper and when you're writing your paper, magnitude is the numerator, which is how much income you're going to make in the future, and the denominator, which is your discount rate. All right. What affects the numerator? Your skills, your training, your abilities, those type of things. And also your age, obviously, how many more years. What affects the denominator? Well, the next two things. What affects that discount rate? How volatile is your human capital and how is it correlated to the overall economy, to the stock market? Does your human capital look more like a bond or a stock? You could in your paper, and this is where critical thinking can help, is, give an example. So if you got someone, I mentioned Man's Warehouse on commission, someone who sells cars on commissions, their income is very volatile. And when you go into recession, they're going to really be hurt because they're on commission, fewer people are going to buy cars. That's going to be a really high discount rate. It's going to greatly reduce their human capital, and it's going to make their human capital look more like a stock. In that case, they're not going to use much life insurance because their human capital is going to be smaller because of that big discount rate. And they're not going to put as much of their portfolio in stocks because their human capital already looks like a stock. All right. So if you really get critical points if you can think of another example, unlike the ones I just put in class. I use a stockbroker in Men's Warehouse, but there's an auto, selling auto insurance, autos, cars on a commission. All right. So be real careful on these three. They are the biggest part of the points students lose. The mortality is usually really simple. Risk tolerance is really, really simple. Wealth is really simple. These three are simple. Students lose points on that because I just don't put it in the paper, which is always amazing to me. This is probably, I'm sorry.
The example you gave yesterday about the Supreme Court justices, are they high human capital there? Since they have state?
Well, high or low is going to affect the numerator and denominator. So they're probably high because their incomes are really high, but also their discount rate's really low. Why? Because it's not very volatile, because unless they get impeached, which I don't know, have we ever impeached the Supreme Court justice? I don't know if we ever have. Or they just quit. So it's not volatile and it's very stable. And how is it affected by the economy? We go into recession next year. Do they really care? It doesn't affect them at all. So it's a high income because they're highly trained judges that are getting paid a really good salary, and the discount rate's really low. So that means their human capital looks just like a bond and low discount rate. So it's a massive number. So they're going to need more life insurance because they have more to protect. And they can put a lot of their portfolio on the stock market because their human capital is so safe. So you could use that as an example. You can probably find other examples similar to that. Now, the president might not be like that, because he or she, if the economy goes in recession, there's a good chance you're not going to get reelected. You could go extreme and talk to president, but that would be a little more bizarre. So, the more creative, not so much creative, the more you demonstrate you really understand the concept, the more the critical thinking points that you get. Other questions on these? Any of these? These you're going to find in fact, the next one too. These four are very straightforward. You can essentially just reword what the article says pretty clearly, and you'll have full credit on those. Those are the easy ones. This one you got to say more than more research is needed. So read the paragraph and see what more research is needed. They mentioned, I think, 3 things in there, at least 2 I can remember. So make sure you're clear on that. Put it in your own words. And then the optionality, we talked about that last class. Make sure you're really clear on that. Make sure you talk both of these points. Some students completely forget. So on why should young people have more in stocks, it really comes down to human capital. For most people, it looks more like a bond. And for most young people, that's their biggest asset. They got this massive bond-like looking asset called human capital. They can probably put 100% of their money in the stock market. As you age, human capital shrinks, your wealth grows. That's when you got to start worrying about having that exposure to the stock market. So make sure you make that really, really clear. And it's an important point because a lot of financial planners don't understand that. A lot of them talk about time diversification. Stocks are not as risky if you have a longer horizon, and that's just not true. Mathematically, you can prove that stocks actually get riskier as you increase your horizon. So it really has to do with that human capital and how massive that is and how bond-like. So that wouldn't be true for someone whose human capital looks like a stock. Just because they're young, that time diversification financial planners say is not true for young people. If their human capital looks like a stock, they need to put more money in the bonds to offset that risk. All right. So now I want to quickly go through Article 3. It's a much more straightforward article, unless y'all have any other questions on Articles 1 and 2.
Can you just go to the side real quick for that first one? What you typed it.
Yeah, don't start reading until you're really They're answering 2 questions as in the abstract. Remember I said, read the abstract first, then go to conclusion, and then get into the details. And not just for this article, but for any article that has an abstract and conclusion, I would do that. The second article doesn't really do that, so you can't.
Thank you.
You notice I don't list the case studies. The case studies are talking about mortality, risk tolerance, and wealth, but there is some overlap. So you don't necessarily have to go through and say in case 1, they said this, case 2, they said this. You just got to draw out what those cases are saying about mortality, risk tolerance, wealth, and bequest motive. All right, the third article is not at all related to the first 2. So what most students do when they write this paper, they combine articles 1 and 2 into one paper, and then they just stop, and then they just go to the next article. You don't have to transition. You say, you don't even have to say, now I'm going to talk about this. So you can really make it, really, it's 2 papers, a longer paper and a really short paper. The second one's much shorter. So don't try to integrate them or overlap them. You really, the first 2 articles are one thing. The third article is a completely separate thing. Just start from scratch, a whole new discussion. In fact, you could just do a page break and just say, now I'm going to discuss the article or whatever, just get right into it. So here's the second article. I found this article because Babel wrote it. I don't know if David Babel is still around or not. Very, very impressive guy. He came to USA a few times. They were selling something. He's not a salesperson. He is a professor, very brainy, not a people person, but extremely, extremely smart person. So I thought this would be a great article. It is an old article, very old article. But I haven't found any as good as this article, and everything they say in this article is still topical. So I tend to find articles, if I can find a great article that's 15 years old or a mediocre one that's 2 years old, I'll do the 15-year-old one. This is much better written. I was using another one, but this one's just better written. So Babel is somewhat of an insurance guru. He teaches at Wharton, and he does a lot of consulting on the side for the industry. Just extremely brilliant guy. I don't know this person at all. So what are they doing here? So you can see this one's highlighted. One thing you'll definitely get some critical thinking points on, and I think I helped you in a few places, is because this article is so old, you might try to see if you can find an updated version of some of these charts. The one that's the most likely to be able to find, I think it's in the class. I gave an updated one in the class notes. I'll show you. If I can find it. Well, I know I did it, but now I don't see it. There it is. What's it doing way down here? All right, so on page 26 of the notes, I gave you an updated version of this. So one of the things this article is talking about is what do you do when you hit retirement? This is a huge issue. Have y'all heard of William Sharpe, Dr. Sharpe, father of modern finance, Nobel Prize winner? He created what? Sharpe ratio, an even bigger invention. Starts with a C, has 4 words. Capital, asset, pricing model. He's the CAPM guy, all right? So he's Mr. CAPM, famous person. But right now, this is what he's working on. How do people, when they hit retirement, how they take money out? The industry doesn't care because they don't make money on that. So there's no one there helping people take money out. They're helping them accumulate money. Why? Because that's how we make money in finance. People give us money, we manage it for them, we charge them ridiculously high fees. That's where we are. But when people say, now I'm retired, you need to take my money out, we're like, well, good luck with that. So how do we do that? Well, we used to have defined benefit plans. You're not going to have one unless you're in the military or work for the state. But if you work for USAA or Valero or anybody else, no one has hardly any private firms have pension plan. Any of y'all have a defined benefit plan? Some of y'all have a 401k though, don't you, if you're working? So most of you have a 401k. USAA shut down its defined benefit. and just great increases 401k. I fought hard to keep the defined benefit plan, but I lost that argument. Now they sweetened the pot on the 401k. It's a really good 401k plan, but they got rid of defined benefit. What this chart is showing you is the growth in 401k plans and the demise of the defined benefit plans. Defined benefit plans used to be the norm, and 401k. In fact, the 401k was in the tax code, but around 1980, some guy, I don't remember his name, he discovered that paragraph and he discovered, wow, this thing's pretty good. And it just took off. And now it's the most popular. So most of you are gonna have a 401k. Well, defined benefit plan, when you retire, your company says, we're gonna give you 70% of your salary plus inflation until you die. That sounds a lot like human capital, doesn't it? It's a very safe bond looking kind of thing. What does the 401k say when you retire? They wash their hands. They don't care. You figure out what you're going to do. Not our money. And what do? What do most people do? Well, the people I've helped, they take it out and refurnish their house. They buy a new car. There's one woman I was helping. She wanted to retire early. And I was like, you don't have enough to retire. So I really got to retire. So retired. And so I check in with her. How's it going? And she very sheepishly said, I bought a new car and I remodeled my entire house. Okay, so you didn't have enough money and now you really don't have enough money. But what's the problem with the 401k? You can take your money out. Well, on the defined benefit, you can't do anything. The company, they give you the money, you're stuck with whatever that is. So what they're talking about in this article is what do you do when this security goes away and now people are all on their own? How do we help people know what to do? And they're going to talk about something that the life insurance industry has, which is a really good product, hardly sold, but a really good product called an immediate annuity. Now, when you hear the word annuity, let's make sure we're real clear on this because this can get really, really confusing. Mainly because the insurance industry has made it really, really confusing. So you've heard of IRA. What is an IRA? Individual retirement account. It's an account. That A is not annuity. So when you hear the word annuity, what do you usually think about? So we're going to talk about an immediate and deferred. So immediate pays a fixed income from now until death. So an immediate annuity, if you buy an immediate annuity, they start paying you money immediately and they pay you until you die. What's an example of that? Social Security. When you start taking Social Security, what do they do? They start paying you a monthly income. How long do they pay you? Until you die. You should read the story of the first woman on Social Security. It's a really incredible story. She hardly paid into it. And then she got her Social Security and then she lived for a really, really long time. We as taxpayers lost a fortune on that first person. So paid very little in and got back. So her return was just hard to get even calculated. It was massive. What about Social Security? That's not true. About this, Social Security has a COLA. Y'all know what a COLA is? It's not a soft drink. It's a COLA. Cost of living adjustments. So Social Security gives you some inflation. Immediate annuities don't. If you go to a life insurance company and buy an immediate annuity, they may pay you $500 a month for the rest of your life, but it never raises with inflation, all right? But that's an immediate annuity. That's money coming to you. So you walk in and give them 500,000 bucks, and we're going to look. I'm going to use USAA site so you can see how much money. We'll probably compare. What if you're a man? What if you're a woman? What if you're 30? What if you're 60? What if you're 80? We'll compare and see who we get a bigger annuity, immediate annuity, a man or a woman, a 70-year-old man or a 70-year-old woman. Who gets more per month? You guess. Man, why a man? They don't live as long, right? So women don't get as much. Why? Because they live longer and insurance companies live, wow, she's going to live another 30 years. I can only give her $400 a month. A man, he's going to die tomorrow. We'll give him $600 a month. All right. So that's the thought there. That's an immediate annuity. A deferred annuity is not an annuity. All right. It is an investment vehicle to build wealth to fund an annuity. Right? We shouldn't call them annuities, but USA has deferred annuities. What's a deferred annuity? You pay in, and over time it builds up just like any other investment. And then you can annuitize it and make it an immediate annuity. But I don't know why we call those annuities. They're called annuities, but it's just an investment. Okay. It could be just like your mutual fund or buying a bank certificate of deposit. So when we're talking about annuities in this article, we're talking about this. This is what the article is about. So someone says, hey, I'm worried about outliving my money. So what Dr. Babel is saying is you can go to a life insurance company, give them $200,000, and they will guarantee you $500 a month as long as you live. So if you live 5 years, you're covered for 5 years. If you live 40 years, that covers that risk of living too long. It's a really good product, but the insurance industry doesn't sell much of it. That doesn't really sell a lot of it. I mean, relative to the other, they sell a lot of this. They love this. We're going to talk about one of these products that I think is a horrible product, but they sell a lot of it. But they don't sell as much of this. All right, so this article is about the immediate annuity. So when you see the word annuity, don't get confused with this. We're talking strictly here. And so it follows pretty closely. If you look at the rubric, it is very straightforward. So first thing he says is we got a problem. And you can go through the problems. I mean, it's like 1, 2, 3. The article just goes right through them. Social Security, how many of y'all are going to rely entirely on Social Security when you retire? Do you think?
You think it'll even be here when we retire?
Yeah, well, yeah, well, it's like 1 in a 45,000 chance, so we might survive. But Social Security, what's the problem is, we're going to see when we talk about Medicare, the numbers. Boy, you guys should be really, really mad. My generation has ripped you guys off so badly in Medicare and Social Security. It's really pretty horrendous. Why? Because politicians like to give money away, and they've been giving money away to your grandparents every chance they get. And what's wrong with that is that we don't have any more money left. And so Social Security has to pay less because we're just running out of money. We don't have as much. And that's what he's talking about. If you invest in Social Security, what is your expected return over your lifetime? It's for your generation, you're going to make very, very little on what you pay into Social Security because so much of that money. It's worse with Medicare. You're going to see with Medicare and what's going on there. It's kind of infuriating. What's funny to me is the friends my age that post on Facebook about how poor senior citizens need more help, they need more tax breaks and all this, and boy, we're ripping you guys off. If anyone should have a tax break, it's guys your age, because my generation is absolutely ripping you off. I know people worth millions that are arguing they shouldn't have to pay property tax because these poor senior citizens are so deprived. And you guys are working your tails off trying to buy $500,000 houses, and you can't, with 1 bedroom and half a bath, it's skewed. So we have this generational war, and that's what he's talking about here. Social Security was just too rich, overpaid, and now it's coming back to roost in your generation. So that's the problem for people retiring. Social Security will just not pay the bills. The second one I just talked about, there's not as many defined benefit plans. One of the reasons I fought so hard to keep the DB plan at USAA was the people I talked to, so many of them have rated their 401k. The woman I was helping, her 401k should have been $400,000 or $500,000. It was $40,000 because she had rated it so many times. But her pension plan was worth $500,000. That was her retirement. That and Social Security, that's the only way she made it. So she was very fortunate USA had the pension plan because she couldn't rate that. She could rate her 401k plan. She couldn't rate that. So not as many DB plans. Military still has a BD plan. The baby boomers, always an issue. You're going to see the baby boomers is going to be an issue that comes up when we talk about healthcare. My generation, I'm just barely a baby boomer. I think I'm 1 year. If I've been born like a year later, I've been whatever the next generation is. What is next? Gen Z or Gen? I can't keep track of them. There's too many. And then he talks about the post-boomers. Well, there's an echo generation. The post-boomers, these are people that are taking care of their kids and are taking care of their parents, and they're sandwiched. So they got these codependents. And what are those people going to do? It's going to be tough. And why is that a problem? Because there's a lot more retired people relative to workers than we've ever seen before. And so your generation's going to get this double. You can be all these retired. Now it's much worse than say Japan, where there's massive numbers of older people, and the young people are doing what? They're not marrying, they're not having kids. So it's getting really bad in Japan. That country's just shrinking. They're actually trying to pay people to have babies, and the people are like, yeah, it's not worth it. So it's an issue around the world. It's not just in the US, but have y'all heard of yourselves going to be called the sandwich generation? Trying to pay for kids, trying to pay for your parents. It's going to be tough. I'm not trying to depress you, but it hasn't been set up well. And then obviously we're living longer. When Social Security was set up, they set the retirement age of 65. Why? Because that was the life expectancy. 50% of people were expected to die before age 65. Now the life expectancy is 80 something. What do we do with the retirement age on Social Security? Nothing. It's still 65. So people are living longer. If you wanted to add a few kind of gee whiz numbers in here, I think the oldest person in the world just died. I think I saw that she died just recently. Yeah, I think this might be well, unless they updated it. So here's someone who lived to be 122 years old. She was born in 18. I mean, think about that. So was she alive in 2000? I don't know. Yeah, she was. So did she make 2 centuries? I don't know. That 5 years is throwing me off. She almost made it two millennial celebrations. So right now it's someone in France. What country do you notice in the right column there? Japan, there are 3 times. Why did people in Japan? I just saw an Economist article. And why do people in Japan live longer than people in the US? It's an interesting issue. You have someone in the US. These are people who may not be alive anymore. So this is not the people currently alive. So oldest men, not quite as old, but again, Japan you see in there. And then people living, Japan, Brazil, oldest person in the United States is 115 years old. Do you think they're aware of that and are just like hoping these 2 die, you think? Are they just so far out of it? I don't know. What would you be at 115? Is like, no, I'm ready to go now. I don't care if I get the record. I'd be kind of like, let me have it for like 2 days and then I can die just so I get the list. But yeah, it's oldest man, 112. There's no one from the US in oldest man. Why do US men die so much faster than the women? Same thing in the UK, although the oldest man is in the UK. I saw an article that said for every one 80-year-old British man, there's 8 80-year-old British women. So if when you retire as an 80-year-old man, you just move to the UK, you got a pretty good shot of finding someone to take care of you in your old age. So yeah, we're living longer, and not only that, but we got people out there that are trying to find the longevity pill. There's people talking about humans living to 150. What happens to Social Security? What happens to annuities? If we somehow figure a way to get people to be 150. I've seen some of these stories. I mean, it's interesting. We'll talk more about that. We talked to this article, but there's no reason for the body to die at 80, 85, 90. And just to prove it, the proof I saw in one article I thought was interesting. I don't know the oldest woman to give birth. Oldest pregnancy. So essentially a 50-year-old woman, her body can create an entirely new human life. There's no reason our bodies can't regenerate. If a 50-year-old woman can create an infant, why can't that same body regenerate her own body? So our bodies are killing us intentionally. It's not that we're just getting old. It's just so someone's trying to figure out why is our bodies trying to kill us at 50, 60, 70. There's actually chemical reactions that are trying to kill us. So it's not just that we're getting old like a car, because cars are not organic beings. They don't reinvent themselves. So yeah, so if a 50-year-old woman can create an entire brand new human body, she should be able to recreate her entire body itself brand new. But the body doesn't do that. So what if someone finds out, do y'all want to live to be 150? Does that sound good? They'll probably find that pill when I'm 98 and I can live to be 150, but I got to do it in a 98-year-old body. So that doesn't sound too exciting, but so there's things there that are pretty scary. So all you got to do is put those into your own words, and then you get some extra critical thinking points if you can find some updated charts on a few of them. Maybe Google out and find some other things out there, but they're topics that are very, very, very important to your generation because this is what you're facing. So that one's very, very straightforward. And then his recommendations and reasons not to annuitize, there's some overlap in that, but why does he recommend people to annuitize? So the most important one, which is the most complicated, is how to maximize your portfolio. And it's really hard to say. Now, if you don't annuitize, if you're just going to leave your money in your 401k with stocks and bonds, you got to be real careful taking money out, because if the stock market crashes or if inflation takes off, or any kind of thing happens, you're really worried about spending the corpus of that portfolio. And so you're probably not going to get you're probably going to get much less than the full benefit out of that portfolio because you're so cautious taking money out. Once you annuitize, what you're essentially doing is saying, take my portfolio, I'm going to take the max out. I'm going to freely spend my portfolio because this insurance company is going to cover me if I live too long. So it's the way to maximize the value you can get out of your portfolio when you retire. They're not recommending you put all your money into an annuity, but they're recommending for most people, maybe 20, 30% of their 401k. If you build up $2 million in 401k, maybe you should take 300, 400,000 of that and put it in immediate annuity. My recommendation is you use it to cover your expenses. So if you need $50,000 a year to live and Social Security is giving 30, do an annuity to give you 20, 25,000, and then maybe increase that every few years for inflation. So you have that set level of income covered with your annuity, and then your portfolio can invest for the difference. But they talk about that. Be real careful how they talk about it. We'll get into it more when we get into it in detail, because he has some really, really specific recommendations there. And then why people don't annuitize, that's a very simple part of the article as well. So here's his recommendations. So he says, cover your income. What do you need after Social Security? Now, one recommendation they don't have that is really, really good to do, and my word, Dave Ramsey just came out today talking about this, and I strongly disagree with him. He's telling people to take Social Security at 62. But if you wait till 70, Social Security is much bigger if you wait till 70. That 8 years is massive. So what some people have discovered to do is annuitize enough to get them from 62 to 70, kind of give a little extra income, kind of to cover a portion of the Social Security. Maybe they get a part-time job, and then they annuitize enough to make it so maybe they work 2 days a week, annuitize enough, and if they can make it to 70, their Social Security is much, much more massive. So there's a way to kind of work this. So annuitization can kind of get you through the rough spots so you can sleep well at night, and then use the rest of your portfolio to, do the trips with grandkids and those kind of things. But here's his recommendations. You can see they're quite lengthy, so read them very carefully. Don't just read the highlighted. And so why people don't annuitize, there's probably more reasons here than here. He doesn't count them. So see how many you come up with, and I'll talk about which ones I see. So don't start with number one. There's other reasons in here. Okay. So just be aware. He miscounted. He should have started like 1, 2, 3, and then he's up there. So be careful. The one I like, well, the two I like actually is this one. Well, if I put that money into annuity, then my children won't get anything. Well, what about the offset of that? I don't put in annuity, I run out of money, then what happens to your children? You're now living in their garage. So this is a little bit of a balance. Yeah, it's a risk that you won't have as much to give them as an inheritance, but there's also a risk you run out of money, you're gonna be moving in with them. So you gotta think about both sides of that. If you're worried about your kids and their impact on them, think both sides. And then the one I really like, you lose control of your funds. That's a good thing. What happens that, I don't know, y'all watch Dr. Phil ever, I watched some of his excerpts. Have y'all heard of catfishing? I don't know what catfishing is. It's amazing that these people are giving millions of dollars away to people on the internet they never met before. It's amazing how many of them traveled and can't get back. You know, it's crazy. People like to take advantage of senior citizens. What happens if you have an immediate annuity? That income's protected from those people that would steal your money. So it protects you from those people that are trying to rip you off. So that's another really nice thing about it. They can't take your Social Security, they can't take your annuity. They might be able to figure a way to get the money out of your 401k and have you do something stupid, but at least you got something. So it's a protection. So sometimes when you're, right now people thinking I'm 60, I've got all my mental faculties, I want control over my money. But you got to remember when we turn 85, 90, our thinking is not as clear and people take advantage of that because there's lonely people and not having the control. Not only do you not have control over it, also other people don't have control over it. So it protects you. So those are kind of reasons you're looking for. So, all right. So that's this article is much more straightforward. So read it. Don't just read the highlighted, but you could go through it the first time, just read the highlighted so you get a sense of the article. So this one I don't think has an abstract. It has an introduction, but it doesn't have an abstract. And I don't think it has a conclusion either. Not a full conclusion. So it's a little briefer. So you could start with the intro, go to the conclusion, but it's not going to be quite as encompassing as the first article was. All right, so read those. We'll talk about them more on Tuesday, get into a little more detail. They're well-written articles. And then we'll look at one other article related to immediate annuities that's not on your paper. All right. Any questions? So I'm going to go to the class notes that are out there on Canvas. I have some comments up here on the paper. We'll talk about that a little more as we get closer, but I want to go to the economics of life insurance. So if you want to follow along on your computers, that's fine, or just take handwritten notes. Have something though. Don't sit there with nothing in front of you because it drives me bananas. At least pretend I might say something intelligent. Right, there's some pretty cool concepts here with life insurance. Some of them are related to property and casualty if you had that class, but a lot of them really are pretty unique to life insurance. So risk is a big part of financial planning. Life insurance, you think about, that's the risk you die too soon, but within immediate annuities, it's also the risk that you live too long. So life insurance does address some important issues as well as health insurance. It's a very difficult thing to define and measure in a way that we can think about it and act on it. What is risk? And in fact, some people make a distinction between risk and uncertainty. So we might actually be talking about uncertainty. A lot of people think of risk as that's the numbers when you're playing a game, like you're rolling dice or you're playing card. You can calculate the risk, you can calculate the probabilities. Uncertainty is when you're not even sure what the probability distribution is. So like us getting hit by a meteor, wiping the entire world out, it's hard to say exactly how they came up with one in 445,000. But right now, people are talking about AI. Is AI going to destroy the world? And people are saying, yeah, there's like a 13% probability or something. How did they come up with that number? That sounds like a number you just made up. So are we talking about risk or uncertainty? With life insurance, it is really actually closer to risk. We have really good statistics on when people die. It does get a little out of whack with COVID. We have, in US, you have a suicide rate in certain populations that's jumped here recently. But those tend to be, they're material, but they're not earth shattering to the insurance industry. They're very easy to handle types of. So life insurance is probably much closer to the statistics, the probabilities you had in statistics probably than property casualty insurance and almost anything else. We have a pretty good idea when people die. So, but what is risk? What is uncertainty? More than one outcome is possible. And for it to be a risk, one of them has to be undesirable. If someone says, you have a risk, I'm going to pay you $1 billion, 1.2 billion, or 1.4 billion. Oh my word, I don't know if I can get $1 billion, 1.2 or 1.4. That's not risky. Your worst case is really, really good. So we're talking about at least one of the outcomes has to be undesirable. It's dying. It's living to be 120 when your money runs out at 98. It's one of those outcomes has to be undesirable. Risk is a situation with a possibility of an adverse deviation from the desired or expected outcome. So your expected outcome might be that you're going to live to be 70. So you have a family, you have 4 kids, and then you pass away at 30. That would be a risk. Or your plan is you save enough money so you can live to be 90 comfortably, and then you end up living to be 110. Then what do you do? So it's an adverse deviation from what you're expected. Most risk analysis, there is an expected outcome. With life insurance, we have mortality tables that tell us the expected outcome. So with most, there is an expected outcome. Key with insurance versus your other risk classes, especially in finance, is that insurance is a pure risk. We're really just looking at the downside. With stock markets, you got the upside, you got the downside, you got the median. Life insurance, I mean, what are your options? You live or you die. There's not like some upside. You die, you live, or you really live. That's kind of not what we're thinking about here. You either live or you die. There's one that's just the expected value, and then there's one that's the risk, the downside. So chance of risk only auto insurance is that type of thing. You either damage your car or you don't. None of you are buying cars because you're going to sell them for a profit. You know, I'm going to buy this car for 10,000. Maybe I might total it. It might be worth 10,000, or it might be worth 20,000. For most people, you buy a car, it's going to be worth less when you finish with it. So you're just looking at the downside. Speculative risk is the investment side. You got a chance of gain or loss, and you got to look at the full distribution. Look at the upside and downside. Insurance has the advantage. We're just looking at the loss side. We could ignore all the gain sides because nothing happens to insurance in that case. We use statistics to explain risk in insurance. Life insurance is the most straightforward. Health insurance is a really tricky one. You have to have statistics to be able to do insurance. If you don't have those statistics, in fact, you look back at the history of mathematics, when we used the Arabic numbering systems instead of Roman numerals, and statistics started getting developed, that's when you first start seeing insurance products being sold, especially for marine insurance, for shipping. Once we had statistics, we could see the probability this ship would make it or not make it based on weather and pirates and whatever. Then people could price it and could actually offer insurance. Before that, you couldn't do it. There are some pretty early examples of life insurance as well, but using early versions of statistics to try to figure that out. So uncertainty is our perception, what we're thinking about. Risk is the actual numbers that we have when we're applying them. And some people's perception of risk is way, way off. But just because your perception is wrong doesn't mean the risk has changed. The risk is whatever it is. So you really want to be brutally honest. I think what happens on the property casualty side is people overpay for insurance they don't really need because they don't have a good understanding. Those that took my P&C class, you know, talking about parts B and C of auto insurance that I don't buy at all. I just think it's a waste of money. But I know lawyers that can scare people to death and get them to buy B and C because they have a bad perception of risk. So it's important when you're buying insurance to really yourself try to get as close to the actual distribution as you can. Someone who has Alzheimer's that runs in their family, they're probably going to have a higher demand for nursing care insurance. But then what's the life insurance company going to know? You have a family history of Alzheimer's, so you're both going to know the risk. But if you have that risk in your family, but you don't know about it, does that reduce your risk of Alzheimer's? No, you have the same risk, you just don't know about it. So there's something you should be worried about, should be insuring, but because you don't know it, you don't have the perception, you're not insuring it. Maybe someone was adopted and they don't realize they have relatives that have a high incidence of Alzheimer's. What can you do now, though, if you're not sure? Yeah, get the test, get the blood test. They'll map your DNA and do you want to know? Does a 45-year-old want to know you got a high probability of Alzheimer's, or would they rather not know? We might talk about that later. There's a really good PBS special that I wish I could find again, where doctors discovered this woman had a high probability of Alzheimer's, but she didn't ask for that. And they didn't know if they should tell her or not. And she walks in the office and the first thing she says is, doctors, I've been having a lot of trouble with memory lately. I don't know, could it be related to this heart thing you've been testing? And they decided to tell her. And she was happy. She went home and told her sister-in-law or sister, you better get tested. And her sister said, I don't want to know. Don't no, hear no evil, see no evil. So some people perception is a choice to be ignorant because they don't want to know. It's a painful thing. What would you do if you know you're going to have Alzheimer's? It's a scary thing. In that PBS special, there was a much younger woman in her 40s that found out about it. And after about 10 years, she wished she had not found out about it because it had such a negative impact. So, but the insurance company is going to do what? They're going to know for sure. They're going to do everything they can to find that out about you to the extent the law allows them, because the insurance company needs the statistics. All right, so here's the basic statistics in insurance. Frequency, severity are the two inputs. Frequency is the probability something happens. Severity, when it happens, how much does it cost you? Works a little differently in life insurance than in property casualty. So in property casualty, we said frequency was the probability you have an auto accident. Severity is how much damage did you do to your car and to everybody else. Who has a higher frequency, a 22-year-old male driver in a red sport car or a 45-year-old married man in a van? The 20-year-old. Do we know that for sure? Absolutely. Does that mean all 20-year-old drivers in red sports cars are bad drivers? No. But the statistics say are so overwhelming that even the good driver is going to be overcharged. They're going to be charged more because they're in that category. Are there some bad 45-year-old married men in vans, driving vans? Yeah, there are some, but they win because they're out. So frequency is based on the group. Now with life insurance, frequency is your probability of dying in any given year. Do all people have the same frequency, all 30-year-olds? Definitely not. So what does the life insurance company do? They're going to break that down as much as they can. What do you think is one category they might look at? Smokers, non-smokers. Yeah, that's definitely one. The smokers are going to die faster than non-smokers. Maybe not at 30, but when you get to 40 and 50, yeah, it can definitely have the impact. What else might they look at? Gender, men versus women. They may look at family history. They may look at your job. They might look at your avocation. If you're bungee jumping every other Tuesday, that might impact it as well. They probably take your weight, take blood tests. So there's all kinds of things that they can do. What are they trying to do? They're trying to figure out the frequency, the probability that you die. Now, what's the severity? Well, with life insurance, severity is decided up front. For auto insurance, it's not. So they might say you have a 20% chance of an auto accident, but you could do $1,000 of damage or $20,000 in damage. For life insurance, you decide up front. If I die, you pay my family $100,000. So for life insurance, and that makes the math, one of the reasons the math is so much easier in the life inside is the severity is given. How much is the insurance product? Is it 100,000, 200,000, 300,000? We know exactly what the severity is. All I got to do is figure out your probability of dying. All right. So that's pretty straightforward. And then expected loss, you'll see this later when we do the math, is just frequency times severity. The only adjustment here that we're going to make when we price products is we're going to do it on a present value basis. We're going to discount it for time. Your premium and insurance will always be greater than the expected loss. Always. Why? Because the insurance company has expenses and they got to make a profit. How much more? what we're going to see with health insurance. So this is a preview of the second half of the class. Health insurance is a law that says health insurer claim ratio must be 80% or higher, which means it will be 80%. What's the claims ratio? If you pay a health insurer $100, they have to, over time, pay out 80% of that for health coverage. They only get to keep 20% of it for expenses and profits. So what does that mean? Every thing covered by health insurance suddenly becomes 25% more expensive. We're going to talk quite a bit about that. So you can go to the doctor and pay $100, or you can buy health insurance. You buy health insurance, it's going to cost $100, and they're going to add an extra 25% on top of that. So you pay. So which would you rather do? Go to the doctor and pay $100, or buy a $125 health insurance policy that covers that $100? Which sounds better to you? Would you rather just pay the $100 out of pocket? That makes a lot more sense. So we're going to discover with health insurance should be used very infrequently. Because every time we use health insurance, it increases the cost of the thing 25% because you got to pay the health insurance company for its expenses and its profits. Right? You might say, well, health insurers, they're going to negotiate and get better deals. Well, your employer can do that for you too. You don't need a health insurance company to do that. So remember that. The fact that the premium has to be bigger than your expected loss, what that means is when you buy insurance, you're intentionally overpaying for stuff. We'll talk about here a little bit later on the economics. Why would you do that? So why do you do that for auto insurance? Well, because auto insurance is very lumpy. There's a bunch of people who never have an accident. So what are they getting out of their auto insurance? Nothing. They're just paying premiums. But every once in a while, someone has an accident of $30,000 and they get paid $30,000. They're pretty happy. So we're talking about this 80% is not to each person, but it's to the group on average. So a lot of people are going to get zero, and some people are going to get more, and they'll come out ahead. So that's the reason we buy. We'll talk about this more while we buy insurance. So this is an important concept of insurance. Never buy more than absolutely needed. Wow, that's like not even in the ballpark. That's the rule for insurance. So those are to my P&C class. I buy Part A of auto insurance. Part D, I have a massive deductible to pay as little as I can. When my car gets 10 years old, I cancel Part D. And I don't buy B and C. Why? Because I know if I buy insurance, I'm paying more than it's going to cost me out of my pocket on average. Any given year, the insurance might be a windfall. But on average, if I buy insurance, I'm going to end up paying more than if I just did it myself. I don't have dental insurance. If I don't have dental insurance, it's much easier to pay the dentist $100 than pay $125 for dental insurance. It's just much easier to do. It's much faster. I just give them a credit card. So we're going to talk about that. That's going to be really critical for health insurance because life insurance and property casualty insurance usually do a pretty good job of covering just those things that insurance makes sense for. Health insurance covers a lot of things it should not be covering, and all it does is raise its costs. All right, so this is a preview of the healthcare debate. So if you walk into a financial planner's office, this is the process they'll go through. They're going to first figure out what is your goal in life? What are you trying to accomplish? So if you have dependents, they're going to have to talk about, I want to get married, have 3 kids. I want to have a nice house and car and all that. They're going to be looking at, they're going to make sure, okay, what are the risks that are going to destroy that goal of yours? What do we need to manage? You could get sick. You could lose your job. If you die and you have kids, who's going to take care of your kids afterwards? Those kind of things. So first start off what you want to do in life. And once you know what you want to accomplish, you're going to do a risk analysis. You're going to have a list of those risks that you should be worried about. What are those hazards that you have that you're exposed to? And in this case, we're talking about the hazard of dying too young, living too long, having healthcare costs, having nursing care costs, getting disabled and not being able to work. What are those risks that you have that you want to make sure you're addressing? So they'll use questionnaires, they'll have checklists. They'll look at your financial statements to see what might be at risk, any other records that you have. You know, on the auto and property and casualty side, they may do some inspections of the property to see if there's something that would be an issue there. But they're going to try to help you, and they're pretty good at this, realizing that some of them are poorly incentivized to try to oversell you stuff. So you just realize that they're getting paid a commission, they want to sell you more than you need, but still they're going to do a good job of making sure that think through all those things you should be concerned about. The risk assessment is just try to figure out how do all these things interact. How do these hazards interact with your assets and your liabilities to create a loss? And then risk measurement. Let's talk a little bit about risk measurement here. So we're going to use frequency and severity. And I'm going to give you, if you took my P&C class, I did the same thing there. So there's a little bit of overlap in the two classes, but not much. So what kind of risk can you have? So one risk is something, remember this when we get the health insurance, because this can be a big deal. Some risk, they don't happen very often, very infrequent. And when they happen, they're not very expensive. Should you buy insurance for that, knowing that insurance is going to raise your cost 25%? What would you do there? Just pay it out of pocket. Okay, that makes a lot more sense. That might be life insurance for someone with no dependents. Someone told me, a life insurance salesman said, Ron, you still need life insurance if you don't, even if you don't have dependents. It's like, no, there's no way that's true. His argument made no sense. He says, yeah, but you got charities, you got your parents. I say, if I die, those people are all very rich. And I don't want to give them any more incentive that I die early than they already have. My brothers are going to be richer than they've ever been in their life if I die suddenly. I don't need a lump life insurance on top of that. You know, so have you ever watched Forensic Files? You know, what's that program? I mean, how often is life insurance the first thing they look for? Oh, the husband just bought a $2.5 million policy on his wife. Oh, and she just happened to fall off the cliff while they were hiking. That's interesting. Yeah, that's an incentive. So yes, so I don't need that. Physical damage to an old car. That's why I take Part D off of my car. When it turned 10 years old, I just said, if I total it, I'll just leave it on the side of the road. I'll go buy a new car and go home. I don't care. It's worth $500. Why would I insure something worth $500? So the best exposure here is to retain and reduce the exposure. Towing labor is a good example of that. Towing labor is really not that expensive. You may have your car towed every once in a while, but we're talking here for a covered loss. So auto insurance will cover towing and labor for a covered loss, an accident of some kind. In your lifetime, that might happen once or twice. You can handle that. That's a couple $100. People say, well, towing labor is so cheap. Well, yeah, it's cheap because you're unlikely to use it. So you say, it's only cost me $9 a year. Yeah, that's $9 a year over your lifetime. That will be like twice as much as what you would have actually spent if you just did it out of your pocket. That's pretty low. For most people, that's low frequency. I mean, that's low severity. It's not that expensive. Just cover it yourself. So best example I have was I went to Conn's to buy a black and white 8-inch black and white TV. I just needed a backup TV. And at the counter, the guy offered me insurance for the TV. The TV cost $16. The insurance was like $9. And I go, are you joking with me? I said, if I drop it on the way to my car, I'll just come in and buy another one and go. I mean, it's $16. He says, oh yeah. And he kind of laughed and he said, but do you want it? It's like, no, I don't want to spend $9 to insure a $16 TV. Why does he want to sell me that? Because that's where they make their money. When I got my car fixed at Red McCombs, they said, we give you free rental car. Free rental car. What did the rental car guy try to do? Try to sell me the insurance on the cars. I already have insurance. I don't need your, and that's how he made his money. And he was really mad at me for not buying the insurance. It was like, I don't need the insurance. And you do. If you have auto insurance, you're covered pretty. I mean, there's a few places you may be out of out of pocket for a few days, but it's a very, very low risk. Don't spend that money for low frequency, low severity, but a lot of people do. There are a lot of people wasting a tremendous amount of money here. What about something that happens a lot? This is where health insurance comes in. It happens a lot, but when it happens, it's not that expensive. Again, remember, insurance overcharges you, and for this, they're really going to overcharge you. And why is that? What's the key here? High frequency. What does the insurance company have to do? They got to hire a lot of people, don't they? So it's going to cost them a lot. They're going to charge. So they're not going to charge you an extra 25%. They're going to charge a whole lot more because they got all those people sitting there taking all those phone calls because of all these claims. It's terrible, terrible. So would you buy insurance to cover your groceries? So you pay $500 a month. You can go buy groceries, but only the ones on the list, and you get $400 worth of groceries every month. Doesn't sound like insurance, right? Insurance is not intended for those things we do recurringly. So retain. So here's where I put dental cleanings. Dental cleanings are pretty frequent, we hope, once a year. That's pretty frequent. Not that expensive. I always just pay out of pocket. If you do it out of pocket, it's going to be cheaper to buy insurance. Now, some people don't think it's cheaper than insurance because their employer is subsidizing the insurance. So maybe you're paying 60 and they're paying 60, and the cleanings cost 100. So you feel like you're paying 60 and you're getting $100 of cleanings, but what are you really paying? You're paying 120. Would you rather pay 60 and your employer pays 60 and you get to save 100, or would you rather you pay the 100, save the 60, and your employer gives you that 60? Wouldn't that be the best scenario, right? So, so just because what you're out of now, if you're out of pocket 60 and you can't get that 60, then yeah, pay the 60 to save the 100. But the employer should just not be in that game at all. So dental cleanings, I hate dental insurance more than anything. It's a really horrible insurance. What about things that happen a lot, and when they happen, they're horrible? Well, the insurance company is not going to touch that. If you go to Florida right now, you're going to have a tough time buying homeowners insurance in Florida. Those are my P&C class. You remember the mold discussion that we had? When mold hit Texas, you could not buy homeowners insurance in Texas. The insurance industry said, we're not selling anymore. So right now, Florida is going through a big crisis that people can't buy insurance just because everybody's worried about the hurricane season and the hot water and all that. So I don't know why people buy homes on the coast of Texas and Florida. They're so expensive and the insurance is so expensive. I think you're better off just go find a 5-star hotel and go down there once a month and just have someone else that comes cleans your room every day. That's kind of nice. But people do that, and it's just so living on the coast in some of these places, especially now, we're seeing the hotter temperatures and the hotter water in the Gulf. Those are going to be some pretty severe hurricanes. So the best approach is just to avoid the risk. Don't buy the house on the coast. If you can buy the insurance because it's mispriced, then yeah, you can get away with it. Insurance is rarely mispriced. Insurance companies are pretty good at this. You can do some risk control. There are people building homes much, much stronger so they can withstand this, but you got to be careful then. The Insurance Council of Texas tell the story that when one hurricane hit Texas, these families thought they had it figured out. They put their houses way up on stilts. So when the flood waters came in, and they were right, their houses were well above the water. What they didn't realize is when their houses on stilts got hit by a house that wasn't on stilts, floating by, their house just came down. So they were just as bad off as everybody else. So you just never know. 150-mile-an-hour winds are going to do some damage. And it's going to cost you a lot of money. And insurance companies are just not, they do not want to insure wind damage in Texas and Florida. They don't want to insure earthquakes in California. And they're getting worried about earthquakes. Y'all see the earthquake in New York here a few months ago? That was pretty shocking, wasn't it? So insurance industry is getting really nervous on the homeowner side. And it's getting tough. There's places like Florida where it's just hard to buy. So here's where you want to be. Low frequency, high severity. Doesn't happen very often. When it happens, it's really bad. You know you're overpaying, but you're not overpaying much because it's low frequency. So the insurance company doesn't have a lot of staff doing it. And it's low enough frequency that the additional cost is getting divided by a really small number. So it's getting spread out. So you don't really notice it as much. So auto insurance, premature death, when you're healthy and have dependents, these are things that insurance is ideal for. And the key really here is that low frequency, because that's what keeps the relative cost really, really low. Now we're going to talk about health insurance. With health insurance, people are spending a lot of money for things that are not low frequency, and that's why health insurance is so expensive. So that's going to be a big deal. In fact, the first article we're going to read on health insurance is going to say health insurance should only cover this. In fact, the first two articles are going to talk about this. And the first two articles, just so you don't think I have a strong bias, the first one's written by a guy from the right who is a libertarian kind of Republican. The second article is a journalist who's far on the left, who's a Democrat, and they're both saying the exact same thing. We've got to stop buying insurance except for catastrophic low frequency events. We should entirely eliminate insurance for all other events. And that's where I'm going to argue as well. So I'll see if I can convince y'all that that's the right answer. There are some things that are low frequency, but they're so high severity that it would wipe out the entire insurance industry. Those are the ones on the homeowners insurance side people are worried about. The earthquake in California or some just incredible hurricane. The nice thing about hurricanes, if there is a nice thing, is they destroy themselves. So there is a limit on hurricanes. And a hurricane gets strong enough, it cools the water, which kills the hurricane. So its strength causes the thing that kills the hurricane. With earthquakes, I don't know if y'all have seen the difference between a Richter scale 5 earthquake and a 9 earthquake. It's not linear. It's massive. And so what happens if a 9 or a 10 hits California? We don't know. It's going to be incredibly devastating. It's a very, very low frequency, but it would probably wipe out the insurance industry. So there are some. I can't think of anything like that on the life insurance side, except for maybe the meteor hitting the earth. But in that case, we're all dead. The insurance company doesn't pay anything. So it's hard on life insurance to think of a scenario where just a lot of people all die at one time. If North Korea put a nuclear bomb over here, how many people you think they could kill at once? 100,000, 200,000, maybe. Even that wouldn't be as large as what a hurricane risk is, the PNC side. And I'm not saying it's a good thing that we wouldn't worry about it. It'd be a horrible thing, but it would not impact the life insurance industry nearly as much as what we see with hurricanes and earthquakes. So the life side's pretty well protected. Now, healthcare probably is as well. The pandemic, you did see increase in mortality, but it didn't really hit the life insurance industry that badly, mainly because most people dying with COVID were older, and a lot of older people don't have life insurance because they're too old to have life insurance. So it's hard. Can y'all think of a scenario where life insurance should be wiped out? A whole lot of people die at once. I mean, that's pretty rare, especially in the U.S. I know in Indonesia they have that monsoon that killed like 100 and something thousand people. So there can be, but those are countries that don't have good infrastructure, and that just increases loss. I mean, these are terrible, terrible things. But the question we're asking: can the insurance industry step in and be the backstop for these kind of things? And as long as they can do the math and have some confidence in it, they'll insure, especially these type of things. And so you should go back and make sure you're not buying insurance outside of that category, because if you are, you're wasting money. You should just insure out of your pocket. All right, risk controls. That's just what can you do? You can avoid it, but just don't buy a house on the coast. You can do prevention by you're trying to find things that keep the loss from happening. That'd be like exercising, eating right, those kind of things to reduce your chance of death or chance of health problems. And the risk reduction is the loss has already happened. What can you do to reduce the severity? So your house gets hit by a hurricane. You put up boards. You make sure you move furniture to another location. Those kind of things. So the loss has happened or is happening, but you're reducing the loss. It's hard to think of risk reduction on the life and health side, but we may find some examples there. And then you get to insurance. After you've done everything you can do to manage the risk, then you go to the insurance industry and you find people to share the risk with you. And then at the very end, you have some risk that you just retain and you take care of out of your own pocket. So, all right, we'll start here next class.